Have you ever wondered how the world's most successful investors built their fortunes? The answer lies in the timeless wisdom of Benjamin Graham's classic book, The Intelligent Investor. But don't worry, you don't need an MBA or a Wall Street pedigree to understand Graham's insights. In this video, we're breaking down the key lessons from this legendary investing guide in plain, everyday language. So get ready to learn the secrets to building real, lasting wealth through smart, disciplined investing. The question is, are you ready to become an intelligent investor? Key Lesson 1. Investing versus speculating. We all want to make money, right? But there's a big difference between investing and speculating. Graham emphasizes that investing is all about buying solid companies at reasonable prices and holding them for the long term. Speculation, on the other hand, is basically just gambling, trying to make quick profits by predicting market movements. Now, we're not saying speculation is inherently bad. Some folks do make a killing with it. But for most of us, it's a risky game that often ends in losses. Graham's approach is all about playing it smart and safe, focusing on tried and true principles instead of chasing get-rich-quick schemes. So what separates an investor from a speculator? Investors do their homework, analyzing a company's financials, management, and competitive advantages. They look for businesses with a solid track record, strong fundamentals, and a margin of safety in their stock price. Speculators, on the other hand, are more concerned with hot tips, rumors, and trying to time the market. Key Lesson 2. Margin of safety. This is one of the core concepts in Graham's philosophy, and it's all about avoiding overpaying for an investment. We're looking for stocks that are trading at a significant discount to their intrinsic value, providing a margin of safety against potential losses. Think about it this way. If you buy a stock trading at $100, but its true value based on the company's assets, earnings, and growth prospects is actually $120, you've got a built-in margin of safety of 20%. Even if the market takes a hit or the company stumbles a bit, you're still in a solid position. Now, determining a company's true value is no easy task. It requires a ton of research and analysis. But Graham lays out some key metrics to look for, like a low price-to-earnings ratio, a high dividend yield, and a strong balance sheet with plenty of cash and minimal debt. The margin of safety concept also applies to bonds and other fixed-income investments. Graham recommends sticking with high-quality bonds and avoiding anything too risky or speculative. Key Lesson 3. Mr. Market. One of the most famous analogies in the book is Graham's personification of the market as an emotionally unstable guy named Mr. Market. The idea is that the market is constantly offering to buy or sell stocks at different prices, and those prices often don't reflect the true underlying value of the companies. Some days, Mr. Market is euphoric, offering to sell stocks at ridiculously high prices. Other days, he's in a deep depression, practically giving away shares for pennies on the dollar. As intelligent investors, we need to be level-headed and rational, ignoring Mr. Market's mood swings and focusing on the actual value of the businesses we're considering. When Mr. Market is overly optimistic and share prices are sky-high, that's not the time to buy. Those are the times to be patient and sell off some of our holdings at a profit. Conversely, when Mr. Market is being pessimistic and driving prices down irrationally, that's when we should be ready to pounce and pick up bargains. The key is having the discipline and emotional fortitude to go against the grain of popular sentiment. As Graham puts it, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Key Lesson 4. Defensive investing. While some investors are comfortable with a more aggressive, growth-oriented approach, Graham advocates for a defensive investing strategy, particularly for those nearing or in retirement. The goal here is to minimize risk and preserve capital, not necessarily to shoot for the highest possible returns. So what does a defensive portfolio look like? For starters, we're talking a heavy emphasis on bonds, preferably high-quality government and corporate issues. Graham suggests allocating at least 20% of your portfolio to these fixed-income investments, and potentially much more if you're particularly risk-averse. On the equity side, we want to focus on large, well-established companies with long histories of consistent earnings and dividends. These blue-chip stocks may not offer explosive growth potential, but they tend to be relatively stable and less vulnerable to market volatility. Graham also recommends diversifying across multiple industries and sectors to further reduce risk. And he cautions against overexposure to hot sectors or trendy stocks, no matter how tempting they may seem. Another key element of defensive investing is keeping a cash reserve on hand, perhaps 25% or more of your portfolio's value. This provides a cushion during market downturns and allows you to take advantage of opportunities when they arise. The overall philosophy here is sleep well at night investing. We're not swinging for the fences, we're playing it safe and steady, protecting our nest egg above all else. Key Lesson 5. Patience and discipline. One of the biggest challenges for investors is mastering their emotions and sticking to a well-thought-out plan through thick and thin. Graham emphasizes that successful investing requires an enormous amount of patience and discipline. We've all been there. You buy a stock, it immediately starts dropping, and that little voice in your head starts screaming, "Get out! Sell it all before you lose everything!" But panic selling is one of the worst things you can do as an investor. More often than not, those knee-jerk reactions just lock in your losses. Instead, Graham encourages us to have conviction in our investment theses and the patience to ride out short-term fluctuations. The market's going to have its ups and downs. That's just the nature of the beast. But over the long run, solid companies with strong fundamentals tend to recover from downturns and continue growing. On the flip side, when the market is soaring and everyone's getting rich quick, it's easy to get caught up in the hype and start making impulsive, undisciplined decisions. Maybe you pile into a hot tech stock without really understanding the business. Or you start using leverage and margin to amplify your returns and your risk. Graham would urge us to keep our heads and avoid these temptations. Ultimately, successful investing is a marathon, not a sprint. It requires tuning out the noise, ignoring the short-term zigs and zags, and sticking to a disciplined, well-researched strategy through all market conditions. Key Lesson 6. The importance of tempering greed. Let's be real, we all want to get rich. There's nothing wrong with having that goal. But Graham warns that unchecked greed can be an investor's downfall, leading to reckless decisions and heavy losses. Think about all the folks who got caught up in the dot-com frenzy of the late 90s, pouring money into companies with no actual revenue or business model, just because they thought those stocks would keep skyrocketing. Or the people who bought houses they couldn't afford during the mid-2000s housing bubble, speculating that property values would just continue climbing indefinitely. Greed caused them to abandon logic and common sense. Graham advocates for a more measured, realistic approach. We should absolutely aim to generate attractive returns over the long haul, but we also need to accept that there are inherent limits to what the market can realistically provide. Expecting to double or triple our money every year is just setting ourselves up for disappointment and potential ruin. So what's a reasonable goal? Well, Graham suggests that earning returns of 7 to 10% per year, after accounting for inflation, on a diverse portfolio of stocks and bonds is a perfectly respectable target. It may not sound like earth-shattering riches, but compounded over decades, that's how fortunes are built. The key is having the self-awareness and discipline to be satisfied with those steady, reliable returns year after year. Don't let greed cause you to gamble away your hard-earned gains by chasing get-rich-quick schemes or taking on excessive risk. As Graham famously said, the investor's chief problem, and even his worst enemy, is likely to be himself. There you have it, 6 key lessons from Benjamin Graham's legendary book, The Intelligent Investor. At its core, this philosophy is all about taking a rational, level-headed approach to investing. Do your homework, manage your risk, and resist the urge to get caught up in market manias or paralyzed by periods of panic. It's a simple formula, but one that has created countless millionaires over the decades. So take Graham's wisdom to heart, and you'll be well on your way to achieving your financial goals.